फ्रेंड्स, स्वागत है आपका हमारे यूट्यूब चैनल में। आज हम आपके लिए फिर से एक नया वीडियो लेके आए हैं। तो वीडियो को शुरू करने से पहले अगर आपने हमारा चैनल सब्सक्राइब नहीं किया है तो चैनल को ज़रूर से ज़रूर सब्सक्राइब करिएगा और बेल आइकन दबाना बिल्कुल मत भूलिएगा, ताकि हम फ्यूचर में कोई भी वीडियो बनाएं उसका नोटिफिकेशन सबसे पहले आपको मिल जाए। वीडियो को लास्ट तक ज़रूर देखिएगा। अगर आपको हमारा वीडियो अच्छा लगता है तो एक लाइक और कमेंट ज़रूर करिएगा। तो चलिए वीडियो को स्टार्ट करते हैं। तो आज के टॉपिक में हम आपको बताएंगे व्हाट आर द डिफरेंट टाइप्स ऑफ सिक्योरिटी। सो लेट्स स्टार्ट। अ सिक्योरिटी इज जनरली अ नेगोशिएबल इंस्ट्रूमेंट representing financial value. So let's talk about the debt security. Under debt security, first one is banknote. They are also often called as bill paper money or simply a note. Is a kind of negotiable instrument, a promissory note made by a bank payable to the bearer on demand, used as money and in many jurisdictions in legal tender. In addition to coin, banknote make up the cash or bearer form of all modern fiat money within the expectation of non-circulating high value or precious metal. Commemorative issue coins are used for lower value monetary unit, while banknote are used for higher value. Under debt, second one is bond. A bond is a debt security in which the authorized issue owes the holder a debt and depending on the terms of the bond is obliged to pay interest, that is known as the coupon, to use or to repay the principal at a later date termed maturity. A bond is a formal contract to repay borrowed money within interest at fixed interval, that are semi-annual, annual or sometime monthly. Third is asset-backed security. It is a security whose value and income payment are derived from and collateralized or backed by a specific pool of underlying assets. The pool of assets is typically a group of small and illiquid assets that are unable to sold individually. Pooling the asset into financial instrument allow them to sold to general investor, and this process is called as securitization and allow the risk of investing in the underlying asset to be diversified, because each security it will represent a fraction of total value of the diverse pool of underlying asset. The pool of underlying assets can include common payment from credit card, auto loan, mortgage loan, to esoteric cash flow from aircraft lease, royalty payment and movies revenue. Fourth is mortgage-based security. A mortgage-based security is an ABS that represent a claim on the cash flow from mortgage loan through a process called as securitization. The process of securitization is complicated and is highly dependent on the jurisdiction within which the process is conducted. The basics are mortgage loan. Mortgage notes are purchased from banks and other lenders are assigned to a trust. And the trust assemble these loans into collection or pools. And the trust securitize the pools by issuing mortgage-backed security. Fifth is CMO. CMO is a debt security issued by abstraction, a special purpose entity, and is not a debt owned by the institution creating and operating the entity. The entity is the legal owner or asset or mortgage called as pool. Investor in CMO buy bond issued by the entity and they receive payment from the income generated by the mortgage according to a defined set of rules. Sixth is CDO, that means collateralized debt security. These are the type of structure ABS with multiple branches in structure finance or tranche, often misspelled as tranche or tranche. It is one of a number of related security offered as part of the same transaction that are issued by a special purpose entity and collateralized by debt obligation including bond and loan. Each tranche offers a varying degree of risk and return so as to meet investor demand. Collateralized debt security values and payment are delivered from a portfolio of fixed income underlying assets. Seventh is debenture. A debenture is a document that either create debt or acknowledge it, and it is a debt without collateral. In corporate finance, the term is used for a medium to long term debt instrument used by a large company to borrow money. So now let's talk about the equity security. First one is common stock. It is a form of corporate equity ownership, a type of security. The term voting share or ordinary share are also used in other part of the world. It is called common to distinguish from preferred stock. If both type of stock exist, common stockholder cannot be paid dividend until all preferred stock dividend are paid in full. In the event of bankruptcy, common stock investor receive any remaining fund after bondholders, creditors and preferred stockholder are paid. As such, investor often receive nothing after a bankruptcy. Next is preferred stock. It is a special equity security that has both property of equity and a debt instrument and is generally considered a hybrid instrument. Preferred as senior to common stock but are subordinate to bond in term of claim or right to their share of the asset of the company. These stock carry no voting rights but may carry a dividend and may have priority over common stock in the payment of dividend upon liquidation. Similar to bond, these stocks are rated by the major credit rating company. The rating for preferred is generally lower since preferred dividend do not carry the same guarantee as interest payment from bond and they are junior to all creditors. Next is derivatives. A derivative instrument is a contract between two parties that specific condition under which payment or payoff are to be made between the parties. Derivatives are broadly categorized by the relationship between the underlying assets and the derivatives, such as forward option swaps. The type of underlying assets, such as equity, foreign exchange, interest rate derivatives, commodity, and credit derivatives, the market in which they trade, and their payoff profile. Based on the relationship between underlying asset and derivative, first is forward. It is a non standardized contract between two parties to buy or sell an asset at a specific future time at a price agreed to day. This is in contrast to a spot contract, which is an agreement to buy or sell an asset today. The party agreeing to sell the asset in the future assumes a long position, and the party agreeing to sell the asset in the future assume a short position. The price agreed upon is called delivery price, which is equal to the forward price at the time the contract is entered into. Second one is option. It is a derivative financial instrument that specify a contract between two parties for future transaction on an asset at a reference point. The buyer of the option gains the right but not the obligation to engage in that transactions, while the seller incurs the corresponding obligation to fulfill the transaction. The price of an option derives from the difference between the reference price and the value of underlying asset plus a premium based on the time remaining until the expiration of the option. Other type of option exist, and the option can in principle be created for any type of valuable asset. Next is swap. Swap is a derivative in which counterparties parties to a contract exchange cash flow of one party financial instrument for those of the other party financial instrument. The benefit in question depend on the type of financial instrument involved. So that's all what I have tell you about the types of security. If you have any query in any of the slides, you can feel free to comment me in the comment box. And if you like my video, please press the like button and don't forget to subscribe my channel for more and more updates. Thanks for watching my video till the end.